Thumbs up, brilliant. Okay, right, we'll now go back to the lobby and admit all. Admit everyone. Okay. Morning, Andrew. Morning, Aaron. Morning, Bob. Morning, Bobby. Morning, everybody. Thanks for joining. Morning, Laura. Morning, Jack. Good morning,
Stalker.
Thank you for joining.
Morning.
Thank you for joining.
Morning.
If you've just joined, if you could
How are you
mute,
doing, Henry?
please.
So, very good.
You've got lots of fans on today, Henry, which is great. Chris, if you could mute, that'd be great. Con, if you could mute as well, that'd be great.
Stephen, can I just ask a quick question before we start? Do we
Yes.
have a hard close at 11:30 so Henry can get down to the Mall?
No, we don't. We don't. Thank you for introducing that idea.
Fine. Excellent. Right. Okay. So
Okay.
there we go.
Anyone
Thank
who
you,
wants to get down to the Buckingham Palace, they can see the ladies who did us proud on Sunday evening. But
indeed, they did.
they'll be struggling to beat Mr. Paul Todd of Nest Pensions beforehand.
Well, indeed, absolutely. Okay, right. I think we're ready to go. So welcome everybody. Thanks for joining this week's Pension Playpen. We are delighted to have Paul Todd, CEO from Nest Invest, on to talk about retirement income solutions from Nest and everything Nest going forward. I know Henry's going to be helping nudge things along. I think Paul would probably prefer questions at the end in our Q&A session, but if there's anything absolutely burning, then please raise a hand. As usual, we're being recorded, by the way, so everybody happy being recorded? So thumbs up, Bobby, Chris. Yep. Okay. So without any further ado, Henry, do you want to just quickly briefly introduce Paul, because just in case people may or may not know who he is, but over to you, Henry, and enjoy the session.
Okay, I haven't got much to say other than Paul is somebody who everyone I know knows and think he's a good guy. And Nest have been working harder on this question than I'd realised, because I found snips from Otto Torresson in 2016 saying how important this was for him to get right. That was nearly 10 years ago. So we're interested in hearing what Paul talks about, and we're interested in whether this is a collective or non-collective solution, and we're interested in how he converts pots into pensions over time. After that, it's all Paul. So over to you, Paul.
Thanks, Henry, and thanks, Steve. And it's really good to be here. This has been a long journey for Nest in terms of getting to a place where we're comfortable kind of talking about what we would like to deliver rather than just talking conceptually. So I've got about 10 or 11 slides. On the first half, we'll just try and set some of the context in terms of what we're doing and who we're doing it for. And then the second part will be getting more into the technical detail of how we think we can deliver what we expect lots of our members want and need, and then happy to have have a discussion about our different approach and some of the pros and cons. But to start off with, at Nest, we do spend a lot of time kind of doing research into our membership about what they want, what they expect, and what they need. And a lot of that comes from sort of the inception of Nest, and the fact that the majority of people who we thought would be saving in Nest probably haven't had much exposure to long-term financial savings products. The kinds of solutions that have perhaps been developed in the past may not necessarily be suitable to our particular demographic, which on the whole are people on low to moderate earnings. And I think particularly when thinking about retirement, many of our members would be very, very uncomfortable or unable to seek ongoing financial advice. So I think thinking about that in the context is perhaps slightly different from the market previously, when people had to buy annuities, about how people would interact with financial service products. So basically, since Freedom and Choice in 2014, 2015, we've been doing ongoing research about what it is that the members want in this kind of new world of freedoms where you're not being made to purchase an annuity. And I suspect lots of you will have seen similar research. Lots and lots of different organisations have done things like this. Also, we've reached out to counterparts, particularly in Australia, and we're seeing very kind of consistent messages. And a lot of this shouldn't be that surprising. That what most people are looking for, particularly if they don't have significant wealth elsewhere, is security of an income that will pay out for as long as they live. And you can sort of turn that around and say, well, people had that before. That was an annuity. But if we look at some of the other answers that we got from prospective retirees and our membership in particular, that there's a lot more going on than that. It's not just about security. It's also about flexibility. It's also about making people's money work a bit harder, getting higher incomes. And if I just move on to the next slide, so another kind of similar piece of research. One of the key things I think that's perhaps a little bit different from people with more resources or higher net worth is the research that we found. There wasn't a lot of focus on this is about inheritance planning or this is about passing on to dependents. A lot of the focus, and I sat in quite a few of these focus groups, people talk very much about, no, my pension is for me. This is to replace the wage I had when I was working. And one more point to make about our membership, and there is loads of evidence that we're more than happy to share, and a lot of it's in the public domain. An enormous number of our members aren't going to get to retirement owning their own home. So a lot of our members will still be renting into retirement. So this idea that you take your tax-free lump sum, you pay off the last bit of your mortgage, and then at least you've got a property that you don't have to be paying an ongoing mortgage payments or rental, that will be a different experience for a lot of our members. So the importance, the need for ongoing income, as well as an appetite for it, is pretty powerful in the research. So post 2014, 2015, did lots of member research. We did a big consultation sort of across the UK industry. We also looked a lot to what's going on in America and Australia. And we published a consultation document, and we published a response to that consultation document. And one of the parts of that response was what people were telling us about income solutions. One of the key things that came through, that with the automatic enrolment generation, just as when people are accumulating savings, the importance of defaults and people doing things for you is as important, if not more important, when you're getting close to retirement or when you want to access money. Some of the decisions people have to make are much more complex than when you're building up money. So these kind of guiding principles are about the idea of defaults. So the idea of an organisation doing as much as possible for people who've been saving with them. Key thing, stable income for life. The second thing is about getting high incomes, and then this sort of generates the tension of, well, why wouldn't you just buy an annuity? The third thing, which is very, very powerful, particularly for people at the start of their kind of retirement journey, is the ability to change your mind, that you're not locked into something, that you have some flexibility. And this is where you're getting kind of trade-offs. So if you're trying to get security and guarantees, that pushes you in one direction. If you're trying to get high incomes, that pushes you in a different direction. And if you're trying to have kind of flexibility, that takes you somewhere else. So I think when we've been thinking about this, is there is no one thing that can do all of those things brilliantly, can you find blended solutions which does all of those things well, and maybe does those things well at different stages of a retirement? And the final point, and we'll come on to this in kind of more detail as we get further into the presentation, is the challenges of defaulting people into things where you can't back out of them. So whether that's a crystallization event or whether that's entering a mortality pool, that needs to be done with a lot of care and a lot of caution, not least because we don't have an enormous amount of information on our membership. Our membership, it's huge. But our actual kind of interaction with members on a day-to-day basis is fairly limited at the moment, and that is something we need to get much better at as people approach retirement and as they move through some of our retirement products. So, kind of two last points before I get into the sort of technical solution, and this is I've talked about the retirement income kind of solution before. It's really easy because I've been immersed in it to get the wrong end of the stick of different points. So just a few points of context and some of the constraints we're working under. So the first thing is this can't necessarily be a solution for all of our members. Many of our members are coming up to retirement, have only been saving with us for a short time, and many of them will have quite small pots. Obviously, there's opportunities for people to consolidate with a different provider or bring other money into Nest. But we know that for a lot of people, how do we help them kind of get access to smaller pots efficiently? How do we help them with other solutions which may involve annuitization or some form of drawdown? But recognizing with very, very small pots, there's a limit to what you can do in terms of ongoing kind of sustainable income, and it might not be appropriate for lots of people. Second point is when we're talking about kind of longevity solutions, this is all being done through scheme assets or member assets. There's no kind of backing from the corporation in some form of kind of quasi kind of DB or CDC. This is entirely set within money purchase legislation. So this is entirely a DC scheme. I'm just going to move around. The lights gone off. There we go. Third thing is we are set up under trust, and this is something we've discussed with the trustees a lot. Their role in the kind of key parts of the solution, i.e. setting the investment strategy, setting what a sustainable income rate is, setting how we review that income rate and how we manage longevity risk. The trustees are seeing that as part of their fiduciary duty. So as much as possible, those key things will be done within the product. There may in the future be variations of our kind of default strategy where people can get more involved. But the key thing at the moment is getting something up and running where there is limited kind of member involvement needed, and this idea that people have to become investment experts or actuaries in order to manage their money. And we're trying to stay as far away from that as possible, and also that this can be done without having to take financial advice. A couple of things about some of the constraints. In some ways, it would be much easier if we were starting with a cohort of 500,000 members, all of kind of different ages, with a big pot of money. You can work things out, and you'd have a solution that's probably a little bit different from where we're likely to get to. Our challenge is we have a sort of a trickle of members with reasonable pot sizes coming through in the early years, and then this wall of members coming kind of behind them. And I've got a chart on the next slide that shows that. And then finally, a key point is conceptually quite similar to our kind of accumulation phase investment strategy, is how can we try and as much as possible future-proof this for changes in legislation, for changes in our understanding of member needs, and for new products or new innovations coming onto the market. So can we have a solution where the overall experience for members is pretty consistent, but the way we deliver it can be quite flexible? And then if I just move on to the next slide, this gives a little bit more detail of some fairly simple modelling of how we see the number of members potentially being in the market for this kind of solution. So the light blue at the bottom, which constitutes a majority of members at the moment who are over the age of 55, so they're therefore are able to access their money and maybe starting to think about how they want to access it. The vast majority of those members have less than £10,000. But as you can see, as we go through the years and the decades, that number goes up very, very quickly. So we expect there'll always be people with small pots, even with greater consolidation through the pensions bill. But we can see kind of coming in the distance, this big group of members who may be very, very interested in converting their 10, 20, 30, 40, 50,000 pound pots into a sustainable income for life. And I think that figure, 1.8 million members with pot sizes of more than £10,000, and bearing in mind they may have money elsewhere, that's a pretty big number that's coming up pretty quickly. And we also need to think about how we're investing their money from age 50 to 55 and getting that ready for what we think that they'll do next. Right, so that was the sort of intro part. So now I'm just going to kind of move on to some of the how we think this will actually work. So starting from what we expect a member would see, and I think one of the key things as we're developing this solution further is making this as simple as possible for people to understand and not have to make lots and lots of complex decisions on a regular basis. So in essence, for the first and the years here are kind of rule of thumb. So whether it's 65 or 75 or 85, there's probably some flex around those years. So this is just for illustrative purposes. But the idea for the first kind of two phases, so 65 to 75, 75 to 85, what members will hopefully see is a regular income being paid into their bank accounts on a monthly or an annual basis. And these are things that we'll continue to work through. And where possible, we'd want to pay increases on an annual basis if market performance has been good. So predominantly, most of this money between 65 and 85 is invested in capital markets seeking investment return. I'll come on to different ways we're thinking about that, but conceptually that's what we want members to experience. And then from around about age 85, they would see a steady income that's underwritten to a certain extent, that there will be paid out for as long as they live. All sorts of reasons why we think that makes sense in nominal terms, which we can come on to. But that's the kind of the high level kind of message for members. And then looking kind of underneath the bonnet, we're likely to build this with 2 or 3 key building blocks. So the first one is this idea of a kind of a flexible income account. This wouldn't be visible to members in the way that you might think of fund choices and accumulation, although how we present this information and it is something that they will be working through over the next 18 months. But basically, the majority of people's money at the beginning will be invested, and thrown off from that account will be a kind of monthly or annual income rate set by the trustee and reviewed on an annual basis, so cohort by cohort. Between 65 and 75, the other key thing that's going on is either on a monthly, and I think I think we're fairly confident that monthly makes sense. We'll be hypothecating small amounts of, we sometimes call them premiums, to a separate account. And again, that's not necessarily visible to members, but from an investment perspective, that this will be kind of siphoned off to a separate account. And that will build up over approximately 10 years. And then at 75, with that kind of separate account, we'll transact with a life insurance company to buy deferred bulk annuities on a cohort by cohort basis that then pay out, but pay back to Nest as a scheme, the income for those members who have survived to 85 to allow us to continue paying a steady, sustainable income for the rest of their life. This idea of potentially having a cash account as well, this would be, it's a little bit like the concept of emergency savings, that if people wanted more money 1 month than was actually part of the kind of sustainable rate, rather than having to cancel the whole policy, having an elective cash account where people could put a certain amount of emergency savings, which they could access to avoid having to basically cancel the whole policy and start again. And we think that has some merit and is tested well. The more that is put into that, though, the lower the income. So this is the idea of having it as elective, and we can learn lessons from some of the work that's been going on with sidecar savings. So this is a feature that's not crucial, but it may be an interesting addition if members want it. I think the key thing about these kind of 3 building blocks is, for the first 10 years, so between 65 and 75, this is entirely flexible. So if people want to change their mind, they can take all of their money that they haven't already spent and go elsewhere. And again, that's tested extraordinarily well. The idea of locking up all of your money in an annuity at the age of 65, even when people didn't necessarily fully understand the features of annuities, it just seems like a bad deal. So this is the most amount of money I've ever seen. I'm handing over to an insurance company, and they're giving me very small amounts of money back. There's also quite a lot of fatalism about the idea of, I kind of get that people are living a lot longer, but I'd be the one who dies the day after I buy this purchase. So giving people that kind of comfort that if they think this is the wrong decision, or they change their mind, or something happens fairly kind of early on, that they can completely kind of reverse out of this, is very powerful. And I think the kind of crucial thing is, you're not actually giving up very much. The key thing about the kind of later life deferred bulk annuities is the mortality credits that you would get from people in your cohort dying don't really kick in until 75. So that 65 to 75 period, there's not a lot of additional kind of benefit that you'd be getting for locking that up with an annuity provider or in some kind of mortality pool. So it's trying to find kind of sweet spots where it may not be the perfect solution, but for all sorts of behavioural reasons, it resonates well, and people aren't actually losing anything. Just saw a question about the elective cash accounts. The way we've been thinking about it initially was something like £1,000. So people could have up to £1,000 or a percentage of their initial pot size. And this may be something that we'll be able to present as a slider. So the more you put into this, you can see how your income might decrease. And then this is just presenting the same information in a slightly kind of different way, but this is also how we present the way we construct our target date funds in accumulation. So the key thing that a member would see is you're part of the 2027 cohort. So you have a specific income rate that's unique to your cohort and your age. There'll be the two kind of key factors. When do you enter and how old are you? And then sitting under that are these kind of three kind of sub funds, which again is very similar to the way we construct our target date funds in accumulation. And the amount that goes into those three sub funds will vary depending whether you join at 65 or 55 or 75. So there's flexibility. There's flexibility there. And then this idea of a level 3, again, is very similar to our accumulation phase, where we have all sorts of different asset classes, which are individual mandates with different fund managers, which are then blended into kind of different building blocks. And the point I want to kind of flag here is that's equally true for the later life protected income. So at the moment, what we think is the most sensible approach, and we are sort of well down the road of procuring and delivering this, is using insurance companies or an insurance company to purchase bulk deferred annuities on behalf of members. But there could be all sorts of different ways you could you could get to the same outcome. So lots of discussion going on about legislation for CDC, and in particular decumulation CDC. That's something that we're very interested in. And we could imagine, and looking to our kind of US counterparts, so organizations like TIAA, that if you get big enough and you have enough members, potentially you could run your own internal mortality pool, either within CDC legislation or potentially within money purchase legislation. Or the point I want to make at the moment is that there are a number of ways of achieving similar outcomes. The way we're going about it is a lot to do with where we are in our development, both as an organisation, but in development of the member demographics, and a lot of managing the risk of this, particularly when numbers are small, but then getting very, very big, is using a kind of a similar concept to the way we've done accumulation. So we do the key decision making activity is done kind of in-house, but a lot of the execution is delivered by third-party fund managers, or in this case, a third-party insurer. Just a few more slides, and then we can get on to questions. Still lots of stuff to define, particularly once we get an annuity partner on board. Some key things about the deferred annuity that we need to work out. Issues like death benefits and transfer values. One of the things that has been particularly interesting as we've engaged with the insurance industry to help support the mortality pooling, I'll just skip back to slide 9, is my impression had been that at 75, when we hand over money to a third party, that money is then locked up. In discussions with insurers, that's not necessarily true. There may well be some flexibility on that part of the money that's set aside. So maybe higher when you're 75, 76, 77, and much, much lower when you're 85. But it doesn't mean all of that is locked away as part of a mortality pool and no longer part of your property rights. So thinking through the kind of trade-offs of having high transfer values and high death benefits, which will then clearly kind of dampen the effects of mortality pooling, versus that kind of behavioural thing of people not wanting to feel locked in. It's something that we need to step through. Loads and loads of work about communications, about how we talk about this to members, what the overall kind of proposition is before people arrive, what the communications and the messaging is on an annual basis, where we'll need to be communicating with members about whether or not we will be paying an inflationary increase, whether, if markets have been extremely poor, whether we would ever have to cut incomes. So for that first kind of 20 years, this is not a guaranteed income solution. It only becomes guaranteed when people get to 85. The way we invest the money and the way we set income rates will have an enormous kind of impact on how likely it is we're paying out inflation versus whether we'd ever need to make any cuts. We've been running something not dissimilar to this approach for the last 5 years, and we've learned a lot about how to model and how to set income rates, and some of the challenges there. And I think so quite a lot of the learning is it's quite easy to be overly conservative, both in your investment strategy, but also the rates you're setting. So that's something we need to take forward as we develop our ongoing model. A lot more to do on analytics about likely life expectancy of our membership, how that compares with other members, and I think that will be a really good discussion to have with the insurer when they're on board. We have an investment strategy already as part of our Nest Guided Retirement Fund, where there is no kind of mortality credits, and a lot of the building blocks we're using to deliver that investment strategy are similar building blocks to what we're using in the accumulation phase. We've had lots of really interesting conversations with people internationally and in the UK about there are all sorts of different ways of managing sequencing risk, where you can expose people to the potential for higher returns without necessarily exposing people to some of the worries we have of people withdrawing money in a falling market. And then finally, one of the key things about this solution is getting the governance right about how you make decisions to set initial incomes, how you review those initial incomes, whether or not you can pay inflation this year or a version of inflation, and that's tied in a lot with the way we develop the model going forward. I mentioned bonus payments here. This had been an initial thought that back to those original principles, how do we get as much money to people as early as possible in their retirement? What we don't want is people getting to 85, and because we've been overly cautious, they've got this enormous kind of store of money. And I think that's a bit of an issue in Australia, that people are so nervous about spending their money that they don't spend it. And I think particularly when you think about the challenges that some of our members are having, giving them the confidence to spend as much as possible of their money as early as possible in their retirements, I think is a key part of success. So if people have been benefiting from a lot of good investment performance, we can either be paying that out as inflation, and or we may want to be paying kind of bonus payments, so people can then spend that money rather than trying to set a super high new income level, which then may not be sustainable, and then you may have to keep cutting in the future. These are all things that we'll be working through, but conceptually we've been sort of practicing this for the last sort of 4 or 5 years. And then just finally, kind of next steps. So we are in the middle of the process of procuring an insurance partner. We're reviewing the bids that we've got in at the moment. The aim would be to have that partner in place by the end of this year, so we can do some more detailed design work, particularly on that longevity piece. We'll have lots and lots of work to do with our scheme administrator. This will be the first time we'll have done this in this way, although we have learned a lot from the Nest Guided Retirement Fund, which has been up and running for 5 years now. We've got a lot of work to do on the investment strategy, and we want to rebuild the income model that we built for the Guided Retirement Fund to take into account the benefits of mortality credits. And a lot of the learning we've taken over the last 4 or 5 years is, how can we build things as simple without oversimplifying things. So thinking about how we develop a cohort by cohort model, how we agree kind of governance rules, which are easy to explain up front, so people are understanding what is likely to happen and how those decisions are being made. Hopefully we'll have completed all of that work by the end of 2026, and with a fair wind, the plan would be to have this launched at some point in 2027. And I think this ties in with some of the things we're seeing in the pensions bill and the roadmap about, well, one, the importance of schemes having an income solution that people don't necessarily have to have a lot of contact with. But the second thing is the kind of the importance of trying to manage that longevity risk. The solution we have at the moment, potentially leaves people at 85 having to then navigate a complex market, which people at 65 had serious problems kind of navigating on their own. It feels to us pretty unfair that people would have to do that at 85. So how can we package all of this up where if all a member wants to do is say, turn on my income at this time and then basically leave me alone, that's fine. Sitting around this default solution, we already have a post-retirement fund which is aiming to keep up with inflation, but it's very, very liquid, so allow people to access that as well. We're looking at whether we want to offer additional funds that are more kind of self-select, so a little bit like the fund choice that sits around our accumulation strategy. We don't want to offer hundreds of solutions, but a few to benefit those people who don't want it to be done entirely for them, seems sensible for us. So that concludes. I was going to stop presenting so I can see everybody, but I can always put the slides back up if people want to focus on any charts or any particular parts.
Okay, thanks very much indeed, Paul. I'm sure there are questions coming in. Put your hands up if you want to ask one. I have two questions which are in my head. One is this a collective arrangement, or is this just a bunch of retail arrangements cobbled together as a retail arrangement? And I think I've got a much better answer to that. In practice, it's a collective arrangement. In regulatory terms, it remains a drawdown arrangement. Would that be a fair comment?
Yeah, so this is all under kind of money purchase legislation. It's collective in the sense that we'll be collectively kind of investing, but there's no reserving, there's no synthetic investment returns, cohort by cohort. In the same way as a target fund, you get the return that the market gives you. Our job is to try and manage that, but cohorts are likely to have different experiences depending on when they retire and what age they are. One of our key objectives is to try and minimize those differences, but accept that there will be differences. Yeah. Does that answer the question, Henry?
That sort of gives me the answer back which I was expecting. And the second part of our questions, which I and my colleagues have been discussing the last week or two, is you will have some kind of mechanism to return an income based on what you think is prudent. I guess that's the best way of putting it so far, and that will be supplemented by inflation and bonus payments where appropriate. Would that be a fair way of characterizing what you are looking to do?
Yeah, it's the way we've been working it at the moment is, and then there are kind of a number of moving parts, and part of it, understanding the pricing of the default deferred annuities will be incredibly important. The way we've been trying to do that at the moment is just off kind of gilt yields and mortality expectations. But what the model does, it will take somebody's initial pot. It says you're entering at this stage. This is our expectations of investment return over the next 20 years. This is what the gilt yield is and expected mortality rates. What is a sustainable income for this cohort entering this year, allowing us to pay an income and set aside a small kind of premium to start building up for the deferred annuity. Each year that gets reviewed, both in terms of what the investment experience has actually been. So are you more sustainable than we thought 12 months ago or less sustainable? And each year we're also recalculating what we think the expected return is going to be for the next 19 years. So there's a constant balancing act going on. In a way, conceptually, I think of it a little bit like how well funded is a DB scheme. So if you are overly funded, that means you can do this, that, and the other. If you're underfunded, what does that mean? So in the DB context, an employer would have to put more money in. In this context, we would have to think very, very hard about whether this is the right income level and whether we need to drop that to get you back into a funded position. So it's complex modelling, but conceptually it's fairly straightforward. So the rates.
I understood Best Endeavours DB back in the 1980s when I came into this business.
Yeah.
I'm afraid that's very unfair on DB actuaries who have developed things since then, but it actually does look like it's going to be winding us back 40, 50 years back to the early days of pensions. And I rejoice in that. If I can be able to sort of pass my thoughts into the process, I rejoice in it. Now there are lots of other questions, so let me go straight to the person whose question is number one, and that is Mr. Steve Webb. Steve.
Thank you very much, Henry, and thank you, Paul. That's absolutely fascinating. Huge amount of thought obviously gone in. I've got 1,000 questions, but I'll just cram them down to two. The first is I was surprised by the inflation protection you're targeting in the first 20 years. So in the world we're in, most people retire as part of a couple. Most people have pretty much a full state pension. 2 index-linked state pensions is the equivalent of a pot of about $500,000. So overwhelmingly, people have got index-linked income. Even if the triple lock goes and we link to earnings, that's better than inflation. Even if earnings link goes and we go back to prices, that's still index linked. So vast swathes of their pensions wealth for most of your members is index linked. You've said that you want people to not end up with, unneeded pots at 80 something and enjoy it when they're 60 something. It seems you're spending money on something they don't need. So question one is why faff around? You've got a £30,000 pot and you're spending some of that on inflation protection that they just don't need and which end loads their money. So that's question one. If I squeeze in question two, is in a lot of these flex first, fix later ideas, you don't have to be too prudent, because if you do literally run out of money at 2 years before the annuity age, you just annuitize 2 years earlier. But in your model, presumably if you've got a contract with an insurance company to pay out at 85, it's difficult to turn up at 83 and say, oh, we'd like the annuity anyway. And you've sort of implied there's a bit of flex in this, but could you talk us through that? Because as you've said, there is a cost to prudence. And because you've got something contractual, there's less flex, I would have thought. But fascinating. Thank you.
Yeah, thanks, Steve. On the first point, completely agree, and that's exactly why from 85 onwards, our arguments have been most of your protection will be coming from the state pension. There's also lots of evidence that we've seen about those kind of consumption patterns in retirement, that far from it being a U-shaped consumption curve, it's a lot more. It goes up a little bit and then it starts kind of decreasing, and that is true across all income deciles. And we're being really careful not to think about it as inflation protection or as inflation hedging. And I've distilled those. We had 6 principles and we distilled them down to 4. And one of them was that inflation should be managed but not hedged. So the way we will model it will be not on the basis of we will always pay inflation. It'll be we want to pay the highest kind of flat rate income. But when we kind of modeling the kind of probability of trying to avoid doing income cuts, you end up, if you think about the distribution, that you're so focused on the kind of left-hand side about worrying about those bad times, that you're actually leaving a lot of kind of potential upside, and actually in more cases than half, people will be over sustainable. So what's the kind of release valve for that? And that's what we're seeing. If it's affordable, we'll pay inflation. If it's not, we won't. And then if it's really, really affordable, we'll give people a lump sum that they can spend. So I think a lot of the kind of when we're doing the kind of design phase is trying to kind of flex what that point is. Is it 50% of the time we would expect to pay some kind of inflation increase? Is it 30% or something? And then play around with that to see how you can get back to that first principle. Sorry, the second principle. What's the highest sustainable income? And a lot of this, comes from sort of prospect area that the people are really, really nervous about the kind of downside. So you do want to protect that. By protecting that too much, you give people loads of potential for upside. How do you manage that so you don't get to 85 with big pots? But yeah, this is an ongoing debate about how much inflation protection or management we want to have in place. The bit about annuities, again, this is to be worked out through the default annuity provider, but because it's not flex first and then fix, the entire thing is supposed to be, where possible, the income you get at, say, 65 is almost identical to the income you get at 85. So the reserving of the amounts we have to reserve kind of each month will flex based on kind of investment performance. So we're kind of locking things in terms of what's sustainable at 65, which one is, I think, is beneficial because you're giving kind of members some assurance of what they're likely to get. But that doesn't necessarily mean that on a cohort by cohort basis, it'll be a one-to-one match. So whether there is a bit of flexibility to start things 12 months earlier or 6 months earlier, I think that's to be worked out. But it's a really, really good challenge. I mean, basically, at its simplest, this is trying to use investment when it makes sense to use investment, and insurance when it makes sense to use insurance, and trying to get the best of both worlds. That kind of transition points between, are you doing a better job by seeking investment returns versus mortality credits and pooling mortality risk? I think that'll always be a bit of a grey area. So being able to keep a degree of fudge around that transition, I think will be important.
Thank you very much.
Thanks for the fudge. And let's move on to Aaron Marilada here, who has a question as number 2. Aaron.
Oh, okay. I thought I was going to go after John, but Paul, I don't know if you've heard my presentations about selfies, which is the bond that Brazil issued in 2023. And in a funny way, DMO has, the debt management office, Jessica Pule, has got a real problem because of a decline in purchases of gilts, because DBs are basically being run down. My suggestion, if it's worth anything, is the two of you should sit down, because what you're looking for in the income component, she should be desperate to provide to you. And you can actually guarantee people real retirement income as opposed to a fudge. And this is what Brazil has done. The price changes every day, but the guaranteed income never changes. And I'll send you a paper after this on 2 other things that you can do, which is the dynamic allocation between risky assets and selfies can be managed relative to everyone's target income. So you can actually customize it down to the nth degree. And 2 is, if you actually want to maintain the mortality risk pooling yourselves, then Jessica should be willing to issue you a bond I call the live bond, which is called the longevity indexed variable expiration bond. And that way you may not even need to go to an insurance company if you wanted to go that route. Because at the end of the day, there are lots of risks, which is the expected life expectancy is different from the actual. And the question is who manages that risk and pays for it. So if you haven't looked at the selfies, I'm happy to do a sidebar, but Brazil has proved that you can buy these slices of guaranteed retirement income as small as 1 quid at a time, right? And so even if your pot is 10 quid or 50 quid or 100 quid, you can guarantee that.
Cool.
That's great. Thanks, Aaron. And to my earlier point, this is going to be constructed from all sorts of building blocks. So we'll be able to swap in kind of different ways of achieving the same aims as and when new things come onto the market. So I'd be really interested in talking to the debt office about that.
I'm going to move on to John. John, sorry about missing you. I just missed the order. Off you go.
Was it ever thus? Paul, can I commend you on great research and great presentations? The first bit of sense I've heard about this in probably a decade, which is quite damning. It's not going back to the 70s, actually. This is very similar to what the Dutch did, CDC followed by fixed annuities. So it's a path that's been trodden occasionally. The question I have is, to partner with an insurer with a deferred annuity, where insurance by definition is a point of sale price discovery market, so it's transactional, incredibly hard because it's all about capital. With deferred annuities are capital hungry, much more capital hungry than immediates, and therefore the value that gets lost because of the capital in the equation is quite extraordinary compared to an immediate. So the question I've got for you is, how do you keep the insurers honest when you're...
I've just lost John, but I can have a go at answering that, Henry.
How do you keep insurers honest, Paul?
Yeah, please do answer that question.
Yeah, it's so the contract that we'll be awarding at the end of the year is in two parts. So one is, the first part will be a design phase, helping us design some of the kind of key features about how we would price this, including within that is how do we benchmark this? Because the plan would be initially to start with a single insurer. Again, the operational constraints we're working under, if we had 1 million people on day one, that would be a lot more kind of straightforward than having a few hundred people who are reaching the requisite age. And the way we're seeing this done in the US is a regular auction between 5 or 6 kind of providers, and there, because all of the different insurance companies will have slightly different kind of risks on their books, and will be prepared to price things at different times depending on what they want to take up. We're not going to have that luxury early on, so it's this kind of, it's the trade-offs between sort of outsourcing some of the risk, operational efficiency, and getting good deals. One of the key things that they will be asking for as part of the initial design phase is, how do we benchmark this? So how do we know what is good value, particularly when deferred annuities in this context for a DC scheme haven't really been sold in the UK in this way. So I think, I mean, the key thing to a lot of this is, certainly in the kind of initial period, this is not going to be millions and millions of lives. This is not like the amount of money insurance companies are making at the moment in terms of kind of buyouts and buy-ins with the DB world. So there is a lot of the interest we've had in the market warming is, how do you innovate in a world in which there's going to be lots of DC schemes, and what will be the insurance company's role? So our impression from the market warming we've done and the responses we've had is, people are very, very keen to do this at fair value, and are very, very keen to help us work out what fair value is. I think that this will be something we'll have to consistently keep under review. The alternative is us trying to do it ourselves, and I think in a similar way to the challenges of insourcing all of your investment activity, that might not be the most sensible thing to do early on. It may be something you want to do as you get bigger, as you get more scale, as you get more experience.
Yeah, sure.
So I don't think I fully answered that, John.
It's fine. So you did an auction. I think the one thing I would say is that, without being arrogant, you have something that the insurers do not have. You have access to relatively cheap capital, called your pre-retirement default fund, and that will never be as hungry as the 20% return plus return on capital that the insurers are looking for. So the sooner you get to a mutualizing of that capital between the pre-retirees and post-retirees, the better for all your members. When you get there, you will be amazed at how much value you can deliver to both the pre-retirees and the post-retirees.
I think that's a really, really good point, and I think it's not dissimilar to what we've managed to achieve in the accumulation phase. So the way we've been able to drive down prices and not have to pay performance fees for private markets and things, people see our scale and they see the amount of money coming in and want to work with us. And I think we are doing some interesting things. And I think, you know, generally people in the industry are quite interested in working on interesting things. That's not being naive, that they also want to make a profit, and that's totally understandable. We just want to make sure that the profit they make is reasonable.
Sure. Thank you.
Can I move the conversation on to Bob, because we've got 2 more questions we want to answer, and I want to get them both in. Bob?
Yeah, thanks. Paul, very interesting talk, and it's great that you're doing the work you're doing to look at the various options that you can do to provide ongoing certainty for pensions for older people as they retire from Nest. Many years ago, we were running a very large pension scheme which had a lot of separate insurance company policies, which were all in the name of the trustees. And the trustees basically took those pension payments from the insurance companies as an investment. And I'm pleased to see that you're looking at your deferred annuity approach as being an investment by the trustees, not as individual allocated annuities to the individual members. And that gives you a lot more flexibility. And just to echo John Quinn-Illian's comment, there's not much point at scheme the size of Nest actually buying or securing deferred annuities when you could go straight to annuities if they're held in trust by the trustees, and you have a gap between the pensioner payments being paid and the assets underlying that in the individual members' pot. So if you can create that gap, you can create flexibility. So you could actually have an annuity with an insurance company allocated to an individual within a bulk annuity contract, where the money goes into the trust fund and is notionally allocated to the individual member's pot. And if that individual member, for some reason, needs more money out, cash it out, let's say 20%, you could give a bit extra and then reduce their ongoing payments, even though the annuity that's associated with that individual is still running at the 100% level, or whatever it was. That was the first thing. Second comment is that longevity insurance is probably better than buying annuities and gives the portfolio much better control over its ongoing assets. It's just a thought. But yeah, really pleased you're looking at these options.
Thanks, Bob. That's really interesting. And a lot of these things, so we're not saying this is definitely the only way of doing this, and we are going to evolve this over time. And we've also spent a lot of time speaking to reinsurers as well. And that may well be something that, you know, for example, if we were to run our own internal mortality pool, if we wanted to outsource that longevity risk, doing it through kind of reinsurance or even in an investment mechanism, that may well be options that we get to. I think getting this up off the ground and working with a third party with something that is not a million miles away from products they're delivering for other people is kind of a key part of trying to manage that early operational risk. Once we're up and running, reviewing what's the most efficient way of doing it. Now we have more confidence of the flows of money coming in and how this is working. I think then allows us to rethink how we may approach some of these problems. But it is really good to
we need probably a slight change in the legislation to enable flexibility of annuities, which we haven't quite got at the moment. So that would be good to press the DWP and the Treasury to agree to provide conditional indexation to a degree, but to make it less formal, so you could be flexible on that. So treating member pots as DC pots, but the underlying investments are managed by the trustees and allocated by the trustees as they see fit. I think there's huge opportunities here.
Thanks, Bob. I'm going to ask Peter just to get your question in, if you can, Peter, and we'll overrun a little bit.
Yes, thank you very much, and thank you, Paul, for a fascinating presentation. As someone with the background in DB pensions, I am wondering whether, in fact, you're really running an occupational pension scheme or an individual savings arrangement, as is DC pensions are. And I'm just a little bit confused, and I'm not really expecting to make much comment about the collective approach to an individual product, if you like, and how this matches. And sort of a quick question To put that into context, would you consider transfers in at point of pension commencement into Nest, bearing in mind the people you've got are likely also to have substantial numbers of small pots in other pension arrangements?
Yeah, so on that last point, I think our view would be it often makes sense for people to have a lot of their money in the same place. So whether that's transferring money into Nest from other pots or whether it's transferring their money out of Nest to somewhere else, I think that the changes proposed in the pensions bill about having kind of fewer and bigger kind of schemes, and the scale is helpful. I think will change some of the dynamics anyway, plus the work on dashboard, plus the work on small pots. So I think our view is collecting all your money in one place probably makes more sense as and when you go out and either purchase things or have something delivered. And we've been surprised when we've researched how small a pot people would want to turn into an income, even when presented with what that would mean for actual monthly incomes. So yes, supporting people to either transfer out or to consolidate with Nest, I think will be a key part of the sort of communication and proposition development, and being able to show what different amounts of money would get you, and have confidence, rather than at the moment, I think for lots of people, this is the most amount of money you've ever seen. It seems very, very strange to people that you then have to go buy a product that does something. That when we ask people, what are you going to do at 65? A lot of the time our members are saying, well, that's when you pay me a pension, isn't it? Because I'm in a pension, and a pension is you pay me some money when I'm retired. It's not that's when you go and buy something that may pay you an income, but that may be uncertain. So I do think that's key. The second point about whether this is collective or not, to my mind, it's kind of, there's collective DC, which will have some specific things about mortality pooling and kind of market risk sharing. A lot of those benefits in the accumulation kind of space, I think we can get anyway just through scale. So if you think of the size of our 50 target date funds, they are in effect being collectively invested. People don't have an individual lifestyling kind of matrix, but all of that money is being invested, and it allows us to take a lot of illiquidity kind of risk, particularly with younger members. It allows us to invest in kind of big kind of projects and big infrastructure projects. So a lot of those benefits that you may get in accumulation through CDC are probably being realised anyway, just through scale and having some thought being put into the investment strategy. Where I think collectivization is particularly important is the idea of collectivizing your longevity risk, and I just think it's impossible and unfair to expect people to try and do that. One way of doing it is a way I've suggested through the default, through the deferred annuities, but there could be other ways of doing that, and I could well see CDC decumulation giving people another way of how do you manage that mortality risk within a pool, and that may be something that we want to explore in the future. But people have been talking about CDC legislation for a long time. I responded to consultations back in 2011, 2012. It's still not on the books in a way that's kind of meaningful, and I think we want to be able to get on and do something right now and demonstrate what can be done within the DC purchase, and not wait for potentially a slightly better solution or a more economically sound solution. Again, one thing I would say, and this doesn't mean that you couldn't do this through collective DC, is this idea of flexibility and being able to change your mind and being able to transfer out is surprisingly important, even if it is economically less efficient. So I think any collective mechanism needs to think about the behavioural aspect of, it's not good enough to say yes, but this gives you a higher income. That's not necessarily what people value the most, or certainly not earlier on.
That's great.
Thank you very much.
We're going to have to pull the drawbridge up. There are three things which we go for. One, we want value for money. Secondly, we want retirement income, and thirdly, we want it now. And I don't know if it's in that particular order, but that I think is the age, wage, and pension playpen view of what is needed for people in retirement right now. So thank you very much. I was really impressed and really pleased that we had the opportunity to ask these questions of you, Paul. And thank you to all the people who've asked questions. There are a few in the meeting chat which we'll try and collate. Thanks for people like Chris and Kevin and Rosalind. But we must now pull up the drawbridge. So can we give Paul a thank you? And
well done, Paul. Well done. Excellent.
Back to Steve.
Yeah, thank you very much, Paul. Fantastic session. Are you allowed to send those, or Paul, can we have a copy of those slides at all if anybody wants the slides, or are they internal use only, your slides, Paul?
I'm pretty sure most of this stuff
is out there already
before. Yeah, so right. I'll just double check so I don't get into trouble.
Just double check. That'd be great. Yeah. That'd be great. The video of today will be up later on this afternoon. Thanks to Paul. Thanks to Henry. Thanks for everybody's input. Next week we have a round table, which is the Reform of the Pensions Commission, chaired by Bryn, Lord Davies of Brixton. So please join us next week for that. And as usual, we pray for peace in the East and peace in the Middle East. And let's hope we get some movement there. So, Paul, thank you very much. Enjoy the rest of your day, Paul, and everybody else. Enjoy the rest of your day and week. And thank you for joining Playpen. Hope you loved it. And we look forward to seeing you again soon. Thanks very much. Cheers, Paul.
Thanks,
Cheers, everyone.
Thanks, Henry.
Cheers, Richard. Cheers, Steve. Bye.